We're going to start off and talk about investment accounts quickly. I've gone through and highlighted some of the things that I thought were quite relevant, and I'm sure they're probably quite similar to yours. Now, the first thing that I've highlighted at the top there is cash management accounts, internet accounts, and term deposits. These are all types of investment accounts. We've obviously learned a little bit about those, and we're going to learn a bit more about them. But the bulk of what I've highlighted here is features of each, because they obviously listed down as we go. The first is related to a cash management account, usually a much higher rate of interest. I thought that was of note, and a substantial minimum amount that must be kept in the account. These are two features of a cash management account. When we look at internet accounts, they can obviously only be accessed through the internet. They offer high rates of interest, few statements, and lower fees. So these are three immediate features of an investment account. When they say lower fees, they're talking about the annual fee, usually that is charged on the account to keep the account open with that particular bank. So the Commonwealth Bank might charge you $200 annually as a fee, but they tend to have lower fees than cash management accounts or term deposit accounts. Then we've highlighted about term deposits, that the money must be left in there for a set period of time, and that's referred to as the term. So when they say a term deposit, they're talking about a set period of time deposit, effectively. And then next, I've also highlighted down the bottom there that in relation to term deposits, when interest is paid either monthly or when the term expires. So that is called maturity. So when the term that you've agreed on, so the set period of time that you've had the money in the account is finished, this is called maturity. That's when the term expires, and that is when the interest or the profit that you make on your term deposit is paid. Term deposits are then obviously very safe and provide a reasonable level of return. So they're two features or benefits of a term deposit. Let's scroll down and have a quick look at property. So property is a little bit smaller. When we talk about property, we're talking about purchasing either a home or an apartment. If you were to purchase the property outright, or if you were to purchase the property through a bank, you obviously have a mortgage. If you purchase through a bank, part of the benefit of that is that you no longer have to pay rent. So if you were renting to live, and then you were to purchase your own property, effectively your rent would then become a mortgage if you took out a loan, and that subsequently then goes towards paying off your house. Whereas if you're renting, you're paying off someone else's mortgage effectively. The next thing I put in there is increases in value are not taxed. Now, this is, again, something you can go into a little bit deeper here, is that the increase in value, so if your house increases $200,000 worth of value, so you buy it for $500,000 and then you sell it 5 years later for $700,000, it's increased $200,000 in value. If you are living in that property, it is not taxed. However, if you buy that property as an investment property, it will be taxed. However, for the purpose of this, we're going to say that the person bought the house, has lived in it for 5 years, and then has sold the house. That increase, that $200,000, is not taxed. It goes straight into your bank. I've also highlighted there renting it out. This is another form of, I suppose, investment. If you're to purchase a house that you don't want to live in, you can then rent that property out. So the property value itself won't actually decrease in value, or shouldn't decrease in value. It'd be very rare for it to decrease in value in the current market of Sydney. So whilst you've made your money there, you're also renting it out and making a small portion of money per week. And that's an investment in its own. So that's called income from the rent. And then down the bottom, I've highlighted taxation benefits, because we can talk about that in future. If you want to look into it further, there are taxation benefits, something that's referred to as gearing that you might have seen pop up in the news. But we can talk about that at a later date. We probably will look into it slightly down the track. Shares. So shares, I've highlighted there, a part ownership of a public company. This is something that we have to keep in mind. Shares are bought and sold on the stock exchange. So in Australia, that's referred to as the ASX. Again, something you might have seen or heard about on the news, or listening to conversations with your parents or the radio. The ASX is Australia's stock exchange. I've highlighted the word dividend and dividend among shareholders. So a dividend is a a portion or percentage of profits that is given to shareholders if the company is making money and doing well. So if you are to invest in a company like Coca-Cola and they produce an annual profit of $5 billion, they might decide to pay all their shareholders a percentage on the percentage dollar on every share they own, and that way you receive a dividend. So you receive some money back without actually having to sell your shares. I've highlighted CommSec as they are an internet broker. It's just an example of an internet broker if you wanted to look up an example or a particular company, which you keep in mind will have to do in the next activity. And then a greater depth of knowledge and advice I've highlighted as it's irrelevant to stockbrokers. A lot of people will think, well, if I want to buy shares, why don't I just pick a company that I like or a company that looks to be doing well and invest in that? There are people called stockbrokers who are obviously experts in their field and know a lot about the share market and usually know a lot about the companies that are current and their current performance. So they provide a greater depth of knowledge and advice. So you pay them a fee usually to help you invest your money, and they'll also, that's usually a way of better protecting or getting safeguarding to a certain degree, not completely safeguarding, but better safeguarding your investment. Then I put superannuation as last. So superannuation is a managed fund designed specifically to produce benefits when people retire from work. So a superannuation fund effectively is a fund that you contribute money to, or employers, as I've highlighted next, they contribute a small percentage of their income. Employees, contribute a small percentage of their income into a particular fund of their choice. It's 9.5% at the moment. So 9.5% of your paycheck every week goes into a superannuation fund that accumulates and builds and gets deeper and darker over time. And the goal of that is that when you retire at, say, 65, you receive the money that you've had, this 9.5% that you've been putting away every week of your paycheck comes to you in the form of either a lump sum or a pension from the superannuation fund. Now, this is designed specifically so that when you retire, you don't have to rely on the government to survive. Now, we have an aging population at the moment, which means there are more elderly than there are young'uns, if you want to call them that, or working. So what will happen is as they retire, a big percentage of people will be not working and out, and they'll be living off the money that they've made over their years. So this is basically a safeguard for the government and for people so that they don't get to 65 and realize they haven't saved any of their money, and then they say, well, I can't work, so how am I going to make money? The goal there is obviously that people can turn around and say, I have a superannuation fund with, say, $1 million in it, and $1 million should be enough for me to live comfortably for enough years into the future before I maybe die. So it sounds quite dark, but it's very much there. People do use their superannuation funds to invest, so you can contribute more than the 9.5% now. And those funds are usually, so once you've put the money into a fund or you've contributed your money to a particular fund like Host Plus or Rest Superannuation, for example, and those companies then invest your money and try and get a return on that money. So you're trying to make a profit on that money. So you might contribute $50,000 in a year or $30,000 in a year, and then they might try and get a 3% return on that every year, which means you might be getting $1,500 a year extra. So you're making an extra $1,500 a year, which then gets added to your superannuation account or fund. That's pretty much it, guys, from my end. If there are any other words or terms within that you didn't really get your head around, feel free to highlight them and put your hand up. I'm happy to come around and have a chat with everyone about some things, but we're obviously going to be looking into this in a little more depth in the next activity. So maybe hold your questions till after that, because we're going to be doing some group work, which is a great way for you guys to ask any friends in your groups if they can help you better understand the concept.